It is 4 of December 2013, and these are market truths. What are truths? Facts. What are the facts? The facts are the market goes by price. Bidders and askers, debit and credit. So, will the market crash? Is it a boom or bust? Credit and debt. Debt goes into the market, money, which is a note, which is a promise to pay in the future. That is debt. Debt instruments that we call legal tender. Legal tender is used to purchase, and you make your purchase with a debt instrument. The other side of that, credit, bonds, short sale. So, these are market truths. These are facts. These are price points. And this one we've talked about for quite a while. Is all you would have to do is watch this instrument, the SPX S&P 500. And this line, the cyan line here, we'll look at a different chart that will show this much better, goes back to 2011, August 2011. And we tried to break out of that channel here. We tried to fall out of the channel here, but we found support. We found resistance. We found resistance, support, resistance. Here, out of the channel, a back test, support. We rose up above, and now we have fallen to another back test for support until proven otherwise. This is a daily chart of the S&P 500. Each candle represents one day. Key bank, bust or boom. Back here, I sold a portion of my holdings at $12.98. Now, I could have purchased it back somewhere in here, held off for a 30-cent retrace. However, I went into the options market yesterday and sold a put to open for 54 cents. Reasoning is if this increased in value back to the $12.98, it would have been a move of 30 cents. Sold it at 54. It's already in 20-cent profit now. The option gives you a cushion because of a thing called time premium. This is a credit to your account. When you write an option, it is a credit to your account. It's not a debt because it's not a debt instrument. It is the other side of debt. Again, the reasoning on Key Bank for the option. So, the stock falls from 98 to approximately 58, 40 cents. I would have only made the 40 cents because I would have purchased it somewhere back in this area. You couldn't guess it perfectly. Maybe you can. I cannot. Hoping for a rise in value to receive 40 cents, owning the shares of the stock, I sold to open the put option 13 strike for 54 cents, giving me a 10-cent time premium. Now, as the stock rose in value, I make that as well as I have the 10-cent cushion. But instead of waiting it to go back to $12.98 for a sell of the stock, is I can hold it and make the 54 cents or a portion thereof or roll into the next month. The choice is mine because you have options and options. Here is a better look of the S&P 500. This is the channel that goes back to August 2011. 2-year channel. Here, parallel channel. This is a bear flag. It broke out up here. We are now back testing that. This is the all-time high going way back to 1999 on the S&P 500. So if you purchased in 1999 and you held to 2007, you lost money or you stayed the same in 8 long years. That's why we trade the markets. This is fun, called measured moves. This was the debacle of 1999 to 2008. That was a measured move. So 50% of that move could be a fall zone for support, if you will. It also could rise to that. And look where it is now. And if we look now, it's about 200 points, less than 200 points away from this measured move, which would be 50% of the fall from 1999 to 2008. And here's another cute measure move in here. Let's take a close look. So this is the all-time high of 1999, 2011. And from the bottom of that to this rise here, this top at this time in August, we could use this as a measured move, could we not? Isn't this not the same thing? And amazing how that works out, isn't it? And we're less than 200 points away of hitting that target, which would be 50% of the fall from 1999 to 2008. These are market truths based on facts.